in your writing, you reference the dot plots, the economic summaries of all the individuals that make up the Fed. You know, is this a good idea to stress the crystal ball approach when we have the data-dependent approach, which seems to always get thrown overboard the minute the markets seem to want more from the Fed?
The summary of economic projections was a problematic exercise from the beginning, and that's been 40 years when they've been talking about just the economic forecast. To be even more specific about rates and put individual dots since 2012 has been a real problem. Why? Because it makes you focus on the divergence within the committee, and this is a great example. If there are one more dot for a extra quarter point, markets will converge to that. If there's one fewer dot, then markets will converge to the other thing. If the Fed's data dependent and make decisions meeting by meeting, they don't have to tell us what they think they'll do in 2020 or 2021.
You know, Vincent, I think it's a lot like discovery in the legal profession. The more things you throw out there, the more complicated and more everybody digs into them, just making the pursuit of transparency almost impossible. How would you change that, or is it too late with regard to the Fed and the dots?
It's always hard to take something back because you'll get complaints saying you're now covering things up, you're reducing the amount of information available. I think they should just be more explicit about how contingent they are on the outlook. They can give some very near-term guidance, essentially the tilt. We see more reasons to lower interest rates and raise them in the near term, and then just describe how they think the economy is going and the general direction of policy. The dots are just way more specific than anybody's understanding of the economy.
And not only that, Vincent, let's all be honest here. The track record of the dot plots has not been spectacular by any stretch. We're almost out of time. One other picture I would like to weigh in on, and that is the global picture. Are central banks, particularly ours, going to end up having to be more coordinated with others because it's quite obvious their policies affect our economy? Your final thought.
It's not coordination, it's emulation. What Jay Powell found was when he was raising rates, other central banks were willing to sit back and let the dollar appreciate. When he got into the easing mode, other central banks eased with him so their currencies wouldn't appreciate. And that actually lessened the financial accommodation Powell provided. So I don't think we're ever going to get into coordinating monetary policy. The best we can do is share information and try to get other central banks away from this fear of floating. Trust markets a little more.